Welcome back to the O Show, everything crypto every day. You guys are in for a real treat this evening. I have Andrew Gordon. He is an amazing CPA attorney, does all of this type of stuff, and he's here to answer some of your guys' tax questions that I went ahead and got from the premium members of Crypto Night. How are you doing today, Andrew?
Doing great. How about you?
I'm doing great. Well, it's been a rough week with my taxes. I know because you handled them. It's like, So before we get started, I do want to let you guys know it is so imperative to hire somebody doing your crypto taxes that knows what they are doing. The last couple of years, I didn't know that didn't have the best representation, and I'm lucky because Andrew's helping me, kind of resolve all that stuff. But please, you guys, make sure you're hiring somebody that knows what they're doing, because you're gonna have to pay a lot of money to kind of fix all those mistakes, and that's what we're doing now. So wanted to go ahead and put that out there. But tax season is around the corner, Andrew. Before we get into some of these questions from our Discord members, can you just give us some basic tips and tricks for people, or maybe some important dates? Maybe there was some changes from 2021 to 2022 to prepare, or maybe there's changes from 2020 to 2021.
Sure. So hopefully this is not news to anyone out there, but crypto is reportable. It is taxable. Actually, back in 2019, the IRS introduced a question on the tax return that everyone had to answer whether or not they had crypto activity during the year. And in fact, in 2020 and 2021, it's after your name and address. And so I guess that's the first piece of advice I'd give everyone out there. If you're listening, you almost certainly had crypto activity. And so after your name and address, there's a question. It's a yes or no checkbox. And if you're using software like TurboTax to do your own return, it's generally checked no by default, because a large percentage of the world doesn't have crypto activity. So they check it no by default. But this is a trap that the IRS is laying to potentially charge penalties to us in the future, because if we don't check the box yes, and we had crypto activity, well, we're potentially lying to the IRS. So the first thing to be aware of is that there is a question on the tax return that asks yes or no, not maybe, not I don't know, but whether or not you had crypto activity during the year.
Okay, thank you for that. That's actually very, very important. And I believe my tax people in 2020 didn't check that. I don't remember. But anyways, so is there any other dates that people need to be aware of to file their crypto taxes of 2021 so they don't get dinged?
Absolutely. So the tax deadline is historically April 15th. However, this year, for the first time in a couple of years, it is April 15th. This year, it's April 18th. But for the last couple of years, because of COVID, it was changed. It was June and then May. So now we're back to April. And it's historically April 15th, but there's a holiday on the 15th. So it's April 18th. And that is the deadline to file and pay your taxes for 2021. And we have many clients, and there's many people reaching out to us that their crypto just isn't going to be complete in time. And so if you are unable to file your tax return by that deadline, it's also the deadline to file an extension. And filing an extension gets you 6 months, or approximately 6 months, gets you till October 15th to file your tax return. But another really important thing to know is that an extension is not an extension to pay. It's an extension to file. And so it will get you out of failure to file penalties if you filed before October, but it doesn't extend your payment due date. So if you think you owe money on taxes as a result of crypto or just non-crypto transactions as well, and you're filing an extension, you should also make an extension payment by April 18th as well. And that way you'll avoid failure to pay penalties and interest which accrue on any balance that you would owe between the time you actually file your return and when you pay.
Quick question for you. What happens if somebody has no idea what they owe? What would you recommend they pay? Should they pay $1? Should they pay $5,000, $10? Like, what should somebody do in that particular case?
Sure. And with crypto, it's actually pretty possible that you really don't know how much you owe because you pay taxes on your capital gains, capital losses, offset capital gains, but you don't pay taxes on your overall appreciation or portfolio value. So you may know what your portfolio is worth or your increase in value, but you don't know your tax or your taxable gains. So it's possible that you really don't know. In that case, I would encourage you to make a good faith estimate as best as you can, and perhaps overestimate. Because if you overestimate, then you'll get a refund when you actually file your return and show what's actually due. The IRS will send you a check or deposit it back into your account. But if you underpay, then you'll be charged penalties and interest. And right now, the penalty is 0.5% per month, and interest is 3% a month, but it's looking like it's going to increase to 4% next month. So they're not huge amounts. And we have some clients that say, look, I can have yields on stable tokens that exceed these amounts, and I'll just wait till October. But it is important to be aware that there is a cost to not paying on April 18th, that you will have penalties and interest.
So even let's say, for example, somebody's going to end up owing $50,000, but they didn't think that. So they just sent in a payment of $10,000.
Correct. So then they would have underpaid $40,000. And when they then actually pay that additional $40,000, penalties and interest is going to be calculated between April 18th and when it was actually paid. So and that's why if you're uncertain, perhaps good advice would be to overpay, because if you were just estimating, you thought it was 10,000, but then it was really 50, that's a pretty big difference. So if you overestimate, maybe you pay instead 20, 30, just to be cautious, then you'll get a refund when you actually file, and you won't have penalties. The downside is that you were out of pocket that money during that time, but at least you would avoid penalties and interest.
Wow, that's actually crazy, because then for people that are, part of their income, like let's say it's trading or whatever it is, so they actually have to cash some of that crypto out. So they're going to pay a tax on that, but they might end up getting that back. So that's very interesting to know. And I'm glad that we talked about that. All right. So are you ready for some of these curveballs that I'm going to give you?
Let's do it.
Okay. So first question is how to report taxes on NFTs.
It's a great question. And, NFTs have become more and more popular, especially in the last year. I mean, NFTs have been around for a few years now, but especially in the last year, they've become more popular. There's a few key things to be aware of. First, when you buy an NFT, almost always that's actually a taxable event. When you buy cryptocurrency, for instance, Bitcoin with cash, that's not a taxable event. It's one of the few times that it's not taxable. So crypto with cash, not taxable. But when you buy an NFT, for instance, with another crypto, and most commonly it's Ethereum, that is the disposition or sale of that Ethereum to buy that NFT. If you're buying the NFT with cash or credit card, then that purchase wouldn't be a taxable event. But again, most commonly it's done with Ethereum, with Matic, with some other token. And then that's actually a sale. So even though you don't have cash in your pocket, just buying that NFT with another cryptocurrency, you may have a gain and a tax due. So that's the first thing that I'd encourage everyone to be aware of, that buying crypto may be buying an NFT may be a taxable event. The other thing is when you sell the NFT, just like with other crypto tokens, when you sell an NFT, there's a gain or loss calculated, and that's based on the price that you originally paid for it, and then the price when you sell it. And if that price has increased, then you have a gain, and you're going to owe tax on that gain. If it's decreased, then you've got a loss. And so if you buy an NFT with Ethereum, for instance, and say the Ethereum was worth $10,000 on the date and time that you bought that NFT, then the cost basis, your purchase price of that new NFT will be $10,000. And then say you sell it a month later for $15,000, you have a $5,000 gain. You'll pay tax on that $5,000. Where NFTs become a little bit more complex, and from a tax law standpoint, it's quite murky. And we're hoping the IRS will issue guidance is whether or not NFTs are considered collectibles. So things like art or sports cards, trading cards, in the IRS world has their own classification. They're referred to as collectibles. And as such, they're taxed at a higher tax rate for long-term sales. So for instance, if you sell crypto or stocks that you held for longer than a year, the typical tax rates are 15 or 20%. But for collectibles, it's 28%. So are NFTs collectibles, that's a complex one. And our firm and many other practitioners are analyzing this issue. So it's something that you should talk to your tax professional about as well. So hopefully that's a good overview of NFT taxation.
It is, but one quick question about that, just to expand a little bit. So because I'm in California, if I need to report my taxes for NFTs in California, is that going to be different from somebody who needs to report their NFT taxes in Florida? Because I know some of the states do things differently.
So good question. Overall, there are two levels of tax. There's federal and state tax for individuals. And federal, you're basically on the hook for, unless you're living in Puerto Rico under Act 60, topic for another time, you are pretty much required to pay federal taxes to the IRS. Then state taxes, state income tax, depends on where you live. And so if you're residing in California, you are typically on the hook to pay taxes in California. If you are a resident of Florida, Florida, for instance, doesn't have state income tax. California has quite high income tax. Similarly, New York, New Jersey, other states have high income tax. Then there are states that have no income tax, Florida, Texas, Nevada. And so by living in those states, you can avoid what is in some situations 10% tax. In California, I think it would be even more than 10%. So each state has slightly different tax rules on income and capital gains, but most states tax capital gains and income all at the same rate. And so NFTs would just be subject to this tax rate. And so, for instance, if you were living in California, you might be paying 10% more on your NFT sales than if you were in Florida.
Got it. Okay. All right. This one should be fairly quick, and I might know the answer to it. How to do your taxes with a trading bot?
Sure. So it's complex is the long and short of it. The IRS and the Treasury doesn't have what's referred to as a de minimis tax law. In some countries, if you have transactions or crypto trades under a certain dollar amount, you don't have to report it. So if you buy a cup of coffee in countries like Germany, for instance, with Bitcoin, that's not necessarily reportable. In the US, there is no de minimis law. Every trade, every disposition, every exchange is reportable. It's reportable even if there's no gain. It's reportable if there's a loss. It's reportable if there's a penny of a gain. So the technical answer is that every single transaction needs to be reported. However, some bots are actually businesses for their owners. And in some cases, you may be eligible for what's referred to as a mark-to-market election, which allows you to take the value when you started, the value at the end, and just pay tax on that difference. But the default rule that nearly everyone will fall into, unless you've spoken to your accountant, you've filed elections, is that pretty much every trade needs to be reported, even if that's very cumbersome. There are some times where we can group trades together and use, for example, a high price for the day, a very conservative position. But that would typically overstate tax. So the best approach is the spot price at every single trade. And we've sent to the IRS a banker's box full of paper, full box full of papers to support our clients' trades. On the other hand, we've filed hundreds of tax returns for crypto clients over the years, hundreds of crypto reconciliations. Soon it'll probably be in the thousands. And knock on wood, none of our clients have been audited related to their crypto so far. We expect that to change in the future. Just mathematically, it's going to happen. But what we've seen is by reporting as thoroughly as possible, you're hopefully avoiding further IRS scrutiny. We are getting information every day in our experience in IRS audits that the IRS is getting tons of information from foreign exchanges, things that will shock you in terms of exchanges disclosing information. And so the IRS is getting all this information. It's very easy for their computers to cross-reference what's on the return, what is the information they have. But what they're not going to do is calculate your gain or loss. They're just going to look at, here are all the sales, do all the sales match what's on your tax return? And if that's not true, then red flag, red flag. but they're not going to calculate the gain loss for you. So overall, it's a long-winded way of me saying that it will be very time consuming. You should probably hire a professional. But if you have a bot, you're perhaps at a higher audit risk as is because of the volume of trades. And by reporting it all as thoroughly as possible, you're sharing the full picture with the IRS. You're telling the whole story, hopefully connecting those dots so they leave you alone and you don't have to hire us to represent you in an audit.
Can somebody use like Zen Ledger to go ahead and plug in all the APIs for that particular exchange that they're running the bot to make it easier?
Yes.
Okay.
So yes, there are different software tools out there. Zen Ledger being one of the best that we work very closely with as well. But sometimes when you get into the 100,000s, million trades, which we have clients that do that volume, sometimes then too, we have to work directly with Zen Ledger or find other solutions.
Okay. All right. Can you pick whatever is most beneficial in taxes, or is there a set requirement in terms of HIFO, FIFO, et cetera?
Sure. So this question basically is asking that if you're buying cryptocurrency over time, you're buying it at different prices, and then you sell later on, which crypto are you selling? Are you selling the one that you bought first, which would be FIFO, first in, first out? Or are you buying the one, I'm sorry, are you selling the one that you bought at the highest cost basis? Maybe that was the last one you bought. Maybe that was the one in the middle. And that can greatly impact your capital gains or losses. Because if you choose the highest cost basis, then your gains will be quite low or losses even higher. So it's a great question, and one that the IRS has in part answered and in part has not. So the IRS has issued FAQs on their website, and there's about 40 different questions and answers that the IRS has on there. And one of the questions is exactly this. And the IRS answers it by saying that you have to use first in, first out, unless you can specifically identify your cryptocurrency. And they lay out a brief description of what specific identification requires. But therein lies the debate. For FIFO, which is the default, that is accepted. But could you use specific identification in a LIFO method? Could you use it in a HIFO method? That remains unanswered. We actually have a couple audits ongoing right now where the IRS is taking a very strict position, saying it must be FIFO, or you have to show us, for example, a unique identifier for the crypto, which is doable with NFTs, or that all of the crypto in a wallet was all bought at the same price, and then it was sold from that wallet, and that you could actually show through the blockchain, through an identifier, through something, which crypto was actually sold. That is almost never the case. And so if the IRS takes a very strict approach, then FIFO will be the way that almost 99% of individuals will use. And for the few that can spec ID, they'll do that. But we are arguing that LIFO and other methods should be acceptable under specific ID, but the definition is so ambiguous that we haven't gotten an answer yet. Therefore, we would suggest to people to be conservative, to file FIFO. We know, again, under the IRS FAQ that FIFO is an appropriate method. And also, although FIFO may result in greater gains now, it will generally result in more long-term gains overall. And long-term gains are taxed at a lower tax rate than short-term gains. And that's another very important piece of information for everyone out there. If you hold your crypto for over a year, you're taxed at long-term tax rates. And as I mentioned before, those are 15 or 20%. And short-term is your ordinary tax rate. It could be 30 or even close to 40%. So by holding for over a year, you can cut your tax rate in about half. And if you're using LIFO, for instance, last in, first out, if you're continually buying, it'll be difficult or impossible to have a long-term gain because you're selling the last one you bought. FIFO, on the other hand, you're selling the oldest one first. So all you have to do is wait at least a year from the oldest purchase rather than the most recent with LIFO. So some pros and cons of each, but overall, we tell our clients file with FIFO.
Next question. If you buy Sol to buy an NFT. Sol is at $100. You sell the NFT 2 times at what you bought it for, but now Sol is $150. You hold the Sol and the cash and cash into fiat, but now Sol is $80. What is a taxable event and what do you need to record? I know this is a little bit confusing because there's lots of stuff going on, but I guess just a short, basic answer. Ken,
Sure.
sorry.
So this sounds like an accounting or law school question. So whoever wrote that, I wonder if you were an ex-professor of mine just trying to stump me. Well, the long and short of it is that if you're, as I mentioned before, if you're using one cryptocurrency to buy an NFT, you're using Sol, for instance, to buy an NFT, you're going to have a gain or loss on that sale, even though you haven't received cash. By receiving an NFT instead, it's a sale of that Sol. So now Sol is out of the picture. Now you've got an NFT. And then later on, if you sell that NFT back for Sol, well, then you've got a gain or loss on the sale of that NFT, depending on the original purchase price, which was the fair market value of the Sol that you first sold, and then the sales price now of that NFT. And then you've got a gain or loss. Now you have new cost basis for the Sol that you hold. And now if that Sol goes up or down, new gain or loss. So it's almost like a chain, like a blockchain. Each step is a new transaction, it's a plus or a minus, but it doesn't necessarily matter what happened 4 trades ago. If you had Sol, changed it to an NFT, and changed it to ETH, and changed it back to Sol, it doesn't really have anything to do with the Sol that you held in the beginning. Each of these steps is its own transaction.
All right. This one is about masternodes. Are Gala node distributions taxable if we haven't moved them from the treasure chest? So basically, because I run Gala nodes, I run 3 of them that I just set up finally. But if you run a Gala node, you get the passive income back by, kind of holding on to the coins and helping to support the network. So basically, if you get that passive income back, that additional Gala from running the node, and you don't cash it out, do you have to pay taxes on that passive income you earn from running a node? And I believe there was there's something that was announced regarding this recently.
Yeah. So the general rule and the approach that most practitioners take is that whenever you receive rewards, be it from mining, be it from proof of stake, be it from a DeFi project, that is income to you at the fair market value at the time that it is earned or received. In legal language, when you have dominion and control. However, this is being contested. And so again, just to back up, the default treatment is it's income, it's taxable to you as soon as you receive those tokens, not when you sell it, not when you convert it, not when you move it or do whatever, as soon as you receive it. But there was actually a case in Tennessee from a couple that had, I believe it was Tezos staking rewards.
Mm-hmm. Yeah.
And they paid taxes on those rewards just the same way that I described, that they determined the fair market value, paid tax on that income. However, they, and with the support of other attorneys and Proof of Stake Alliance, they filed a lawsuit against the IRS demanding a refund, saying that that was not the proper tax treatment, and that instead of taxing rewards as income, be it proof of stake, which was the example here, proof of stake rewards as income, that it should only be taxed when you sell it. That approach is similar to, for example, farming or fishing or normal mining. You don't actually pay tax when you pull a fish out of the ocean. You pay tax when you sell that fish. And so the couple with their attorneys were trying to argue that that should be the approach in the way that it is applied with cryptocurrency and staking. As of now, it looks like that case is going to settle, but it will settle without a precedent being determined.
Oh, no.
And so the question will remain open, at least for the time being. And so what we suggest to our clients is to err on the side of being conservative, report it as income, because if you don't, the risk is that it could be potentially fraud, or you could have severe penalties if you don't report it as income. And then we're assessing whether or not it makes sense to file the same path as the other couple took in Tennessee and file lawsuits for refunds for certain clients. But right now, it remains an open question. But typically, if you're getting a reward, it's income to you.
So just pay, guys, and then deal with it later. So you don't have to pay those fines. All right, next one. How are rewards from rebase tokens taxed considering they aren't traceable and registered on the blockchain, which I feel like every single reward is traceable on the blockchain. I could be wrong though.
Sure. So I'm not familiar with this exact fact pattern, but overall, if you have a chain that is anonymous, or even say, for instance, something is happening off chain, that doesn't mean that it's not reportable for tax purposes. The burden is on you as an individual to report and file your taxes accurately. It's not on the IRS actually to figure that out. It's on you. And just because something is anonymous or untraceable, you still need to report. Cash generally used to be referred to as one of the most untraceable things, but in fact, it is not. But even more so, crypto. While in the beginning, a lot of people used to think it's anonymous or this or that, hopefully everyone listening understands that it really isn't. And even with those chains that are anonymous, the legal liability still exists. And what we're seeing is that the government is placing immense resources into making these anonymous systems much less anonymous. And there are news stories happening all the time of people being caught, the IRS or Department of Justice successfully tracing transactions.
Yeah, we won't talk about that one. I believe it was a Bitfinex case. Okay, last question. If you, for whatever reason, cannot get your transactions, what is the best way of doing it?
Yeah, and this actually happens quite a bit in crypto. And in 2022, hopefully a bit less, but in prior years, it happens all the time where exchanges close down, they stop giving you access to the reporting, or they restrict access to US or from US people. All these things happen. And from our experience in dealing with audits with the IRS recognizes that. And they don't expect you to have perfect information. They don't expect you to have every transaction, especially when that data is just not available. But they do expect you to take steps to try to obtain that data. We have clients very frequently that say, well, Binance closed to US people. Right. We can't get that information. But actually, I think all of our clients pretty much have been able to by filing support tickets and requesting that information. And believe it or not, we've actually been hearing rumors that the IRS is getting information from Binance, from foreign Binance, not Binance US, but from Binance. So it's very important to take steps to try to get your records, because if you can get them, typically so can the IRS, and you want to do your best to get those. But if it's impossible, the exchange is closed down, the records are not available, we work with our clients very frequently to come up with assumptions or plug figures. If we know, for instance, what left your Coinbase account to go to Mt. Gox, so it's probably not a great example, but to a different exchange that closed down, and then we see withdrawals from there to a new account that you have. Well, then we can figure out this is what went in, this is what went out. We know a trade had to have happened in between, and plug that transaction, enter that transaction. And the IRS is understanding of those assumptions, but what they don't want is you just to ignore the situation, say, I'm not reporting at all because some of my data is missing. You still should do your best.
So it's safe to say, let's say you can't get access to your Binance account for some reason, but if you do put the effort in and, send support tickets, and even if they don't respond to you, if something does happen, you can say, hey, these are the support tickets. I did my best. There was no response. So at least it does show you're working in the correct direction.
So certainly with respect to other exchanges, I would agree. With Binance, it's just probably not a good example, because from what we've seen, our clients have been able to get those records with some persistence. But there are other exchanges that exactly what you said. You'll file the support tickets, you'll ask for it, and they just won't give it to you, or they're closed down. But then you at least have the support. You have the documentation that you did your best to obtain it. So yes, great advice.
Thank you so much, Andrew, for coming on and answering our questions. Again, you guys, if you're interested in working with Andrew's firm, I highly recommend them. They do really great legal work. They do amazing crypto tax work. I will have the information below, and go ahead, reach out to them. And I highly recommend them. Thank you so much for your time, Andrew.
Thank you very much.